Welcome back to It's Only Money with financial advisor Scott Brown with Edgewater FamilyWealth.com. If you need to get a hold of Scott, the net number is 407-648-1881. I'm Ryan Holmes. And Scott, welcome back to being in studio.
Yeah, I was out traveling last week and was really concerned about the remote conversation we were going to have, but it seemed to have gone pretty seamlessly. I was holed up in my Marriott Courtyard room with my fancy microphone and headset. Modern technology is fabulous.
Always very nice. And it was how's the back?
The back is coming along. It's I have a bad case of old man back. That's all I can tell you.
It happens to the best. I've had old man back since I was like 16 from this dumb workout exercise that I did, and I bent my back in a weird way, and so old man back since I was 16. So
yeah, well, you're ahead of the curve.
Exactly.
Enjoy.
I'm an early adopter of back pain.
Yes.
But speaking of pain, Scott, I don't know what you've been watching the news. I know you were out and about, but inflation seems to be on everybody's lips right now.
Yeah, inflation is. Tammy and I were just talking about this, and I'm going to let the Russian rocket go. We're going to have to change that name, though, apparently. But a lot of people are not in favor of that. He's been getting yelled at on the streets a lot. I don't get it. But so, yeah, Tammy and I were talking about inflation and deflation, in fact, and why some inflation is good and a lot of inflation is bad. So maybe, Tammy, you want to talk to that?
Sure, yeah. So we hear a lot of inflation, stagflation, deflation, hyperinflation, all these combinations that could make us really scared. But it comes really into very simple terms. We can explain it in apples, dollars and apples. If you have $100 and you have 100 apples, normally you'd have $1 per apple. That's simple.
I'm with you so far.
Right. Got this one, yeah.
Ryan's already looking confused.
Right. Right. So, but if you have, let's say, 50 apples and you have $100, normally you have $2 per apple, right? That didn't mean that apples increased in price. It just means the dollar itself went down in value. Make sense?
Sure, I'm with you.
Yeah. If you consider dollars to be just another thing, like it's an exchange, you use it with everybody. So what happens is when you have more dollars, the value will change, and you have more apples, value will change, and goes on. So the problem isn't with when we have that change. The problem is when that change happens too fast. That is the problem we talk about. And that could make some issues. But on the long run, it's not a problem as long as we have production in the economy. That's why in the long run, it is always there. If you do your planning right, you'll do well.
Well, and I think for some of the older people that are my age and older, they remember the late 70s. They remember the early 80s. I was talking to somebody, a client actually the other day, who told me he got his first mortgage. It was 13%. And he told me that the mortgage broker was like, wow, that's a really great rate at 13% mortgage rate. Can you imagine? So, historically, this is not new. Mm-hmm. We've been through periods like this before. We're a little spoiled. We've been dealing with 2% or less inflation, which is probably a good number-ish. 2 to 2.5%, I think, is healthy. But we're getting beat about a little bit right now. And so the opposite of that is some people think, well, inflation's always a bad thing, but stagflation or deflation could be even worse.
Yeah, it is. Because now you have fewer, there's more people normally, population grows. So you need more production normally. So everybody will have the same amount of wealth or even increases. But when you have deflation, so your production is decreasing while population is increasing.
Sure.
So their share of the wealth decreases, and that's what we do not want to see.
That's a bad thing.
Yeah.
Speaking of inflation, you and I were talking about housing numbers this morning. How are we looking on housing year over year, meaning going back 12 months in terms of housing prices? So
sales are down 2.4, but that's the sales where the prices have a different story. Now we have, I'm looking at the numbers here, we have average prices are up 8.5% versus last year.
So your house is worth almost 10% more this year, theoretically, depending on where you live. It could be even more.
Yep.
That's a good thing, right? That's a good thing for overall net worth. I've talked about the fact that the average person, in fact, last week we talked about most people believe their homes to be their best investment, and I talked about why that is, because they can't sell it when it goes down and things like that. But conversely, it's up. you're not going to sell it now either, right? Your house is worth more. You're not going to sell it. Therefore, you wouldn't sell it while it was down. So the point being that most people, that's their biggest asset. So therefore, net worth for people is up.
Absolutely. And it's long overdue. I mean, if you look back at the numbers from 2008, when we had the crash back then, numbers did the value of real estate did not pick up in accordance with the GDP growth.
Sure.
So you would see, surprisingly, when you look at the chart, that numbers are very high now, but are they though? They didn't catch all this 10-year of bull market that we had.
Right.
So and one thing interesting about homes are they're not easy to build. You can't just create millions of them overnight.
Right.
So it takes time for the supply to meet demand.
Supply chain.
Exactly.
Ryan, you got to say supply chain at least 3 times.
Yeah, very, very important. That's a word I definitely understand.
Yeah. So if you're ordering, so some of the hangups are, something as simple as ordering appliances takes 12 months now.
Mm-hmm.
Yes, when I was buying furniture, that was another weird thing where I couldn't get any furniture when we first bought our house because it was they're like, yeah, it comes from overseas and we just don't have any.
Yeah, it's too bad. We'll see you in a year.
The guy at the big box store was like, yeah, and there's nothing you can do about it. And I was like, can I buy the floor model? I was like, no, we need this one to sell furniture. And I was like, you don't have furniture. This is all a lie.
Wait a minute. This is a circular conversation, and I'm falling for it. Here, take my money and don't give me anything.
Yes.
Yeah, so obviously we're going through some bottlenecks. We're going through some supply chain issues. Ryan, you were telling me, to change gears here for a second, you were telling me about a thread you were reading on the internet about retirement planning?
A thread that scared me, Scott. So there's a guy, I believe he's a comedian. His name is Matt Libb, and he posts a article from Market Watch. And the article says, my wife and I are in our 50s with $300,000 in a 401k and $700,000 in a pension. I can't work much longer, and I'm embarrassed we didn't prepare better. Will we be able to live a simple life in retirement? And to this guy's comment on this was like, wait, am I screwed here? Because those are big numbers to me, Scott. And I've looked at that, and I thought about what I have in my account, and it would nowhere near this.
Well, but the good news is you're not in your 50s.
Yes.
So you have time to correct. So these people, it really is a matter of what is a simple life, right?
Mm-hmm.
A simple rule of thumb I tell people is how much money do you have to have in a bucket to produce the income you need? So if you think about these people, let's say they make a median wage and they're probably a combined income of around $100,000. That means their Social Security will be somewhere in the neighborhood of 35, 40, 45,000, maybe 50,000 combined. So that's right there, 50 grand that they're going to get from Social Security. If you think, well, they got $1 million in a bucket at 4%, what does that produce? That would produce about $40,000 a year. That puts them at 90 grand. Is that a simple life? I don't know. It depends on who you're talking to.
It's better than my life now, so I think these people will be fine. I don't know what kind of life they were living before, but the people in the comments would say, this comment thread had like 80,000 comments. It was crazy, and one of them was people saying like, "Oh, my financial planner said I need at least $2 million to be able to retire."
Yeah, I mean, again, it's a matter of what they need, though. If you work backwards off the income number and you say, "I make $120,000" or "I make $50,000," whatever the number is. Historically, how much money do we need in a bucket to produce that kind of income? And if you say, well, what if I earn 10%? That's probably not going to happen, so it's unrealistic. You need to work with a number. We know historically about 95% of the time, 4 or 5% works.
Well, you always make me feel so much better, Scott. That's what I love about this show.
I literally drive to the studio every week, Ryan, just to make you feel better.
And that's what I appreciate. You think Scott is out there to get business for Edgewater Family Wealth? No, it's to come here and have my anxieties be, squashed. And that's what I appreciate about this
You're
show.
welcome.
More than anything, because that's the level of service you get at EdgewaterFamilyWealth.com. By the way, if you need to get a hold of Scott, that number is 407-648-1881, and we will be right back. And welcome back to It's Only Money with Scott Brown of EdgewaterFamilyWealth.com. Scott, and before we went to break, we're talking about pensions and things like that and retirement plans and 401ks. Now, I have a 401k. I just got the standard one. I know there's several versions of it. I believe there's a Bob Ross version. Or is it Roth?
Ross. Yeah. Call it what you want.
Yeah. Am I doing it correctly with the 401k? If just by like employee matching and I'm good to go?
I mean, again, your plan has a match, right?
Yeah.
So it has free money.
You keep calling it that, but it just sits over there and I can't touch it.
Well, that's probably best. There's a lot of jokes there that I'm not going to go to, but the reality is just leave it alone, okay? Yeah, so the reality is it is free money. A lot of people get frustrated with 401ks. They look for reasons why they don't like it. I will tell you that the media is very irresponsible here. And what I mean by that is whenever a writer for a financial magazine gets bored or runs out of things to say, the first thing they pick on are 401ks. Fees are too high, the returns are terrible, the funds are awful, it's a big scam. Which is kind of hilarious to me considering the fact that I've retired myself dozens of people with millions of dollars in 401ks. So are those people idiots? I think not.
Probably not.
So are they perfect? No. Do they have expenses? Sure. But where else can you put money, deduct it from your taxes, and have somebody else put a pile of money on top of it? Because if, the average 401k has somewhere in the neighborhood of a 3% of your annual income match. So for a person making $50,000 a year, that's $1,500 free money being stacked on whatever contribution they make. Now, if you go down to your local bank and you say, hey, man, I'm going to give you $100, and I want you to stack, $1,500 on top of that. They're probably going to escort you out of the building, right? There is no other way to do that. Again, are they perfect? They are not perfect. Are they your father's pension? They are not, because those things have gone the way of the dodo bird unless you're a federal employee or a government employee of some type. But the reality is, as it stands today, something could change tomorrow for all I know, but as it stands today, there's no better way to save, quote unquote, for your retirement.
There's always somebody selling me something, Scott, on the internet. They figured out a way to make some kind of new package of financially, and they're selling it to me. And they've got the book, they've got the fancy outfit, they've got the flashy videos on my TikTok right now. And it's just nothing beats the 401k.
Well, I mean, it's just a structure. It's just a bucket you put money into and you save. It's not, again, here we go again. It's not sexy. It's not exciting. But if you are saying to yourself, I'm not giving the company my money, I don't trust this process, you're just being silly. What you're saying is you don't want to save. What you're saying is you don't want to be responsible. What you're saying is you don't want to do the heavy lifting. I can tell you, in 30 years of doing this, I've encountered people on a fairly regular basis who are aggravated with their 401k, mad at me because their 401k isn't great. What they're really mad at is they're not saving. What they're really frustrated by is there's no easy answer. And they also are looking at fancy videos with shiny things and get-rich-quick schemes.
Yeah, that's the problem. Maybe they should rename the 401k just the get-rich-slow plan. Like, it needs the word rich in it somewhere.
If you probably shouldn't call it that. That's bad marketing. But the truth of the matter is that is how a lot of people have become millionaires. And I think I gave a statistic, and I don't remember how many. You remember, Tammy, the number of millionaires Fidelity reported in 401k plans? But it's hundreds of thousands of people now have over $1 million in their 401k. So, again, we could get all caught up in funds and returns and fees and things we don't like and things that you'll read about in Money Magazine and 10 ways your 401k is ripping you off and nonsense like that. The truth of the matter is employers don't want to do these things, but they have to do them to provide a vehicle for you to save. They don't want to give you 3% of your annual income in the form of a match, but they know to be competitive, they have to. So if you say to them, look, I'm not participating in your 401k, man. I'm not doing it. What you're saying to them is, I know you want to give me some more money over and above my salary, but I'd prefer you don't. That's literally what you're saying to your employer when you choose not to participate, at least to the full extent of the match in your 401k plan.
Now, to the guy, though, that's like, I don't need a retirement plan. I've lived my life crazy. But the 401k, so you're investing in it, and then for some reason you pass away.
Mm-hmm.
What happens to the 401k? Is it transferable? Does that money go to the government? What happens to that? I like when I make you laugh because that means I just asked a dumb question.
Well, no, it's funny because some people think that, like they're just going to confiscate them. It would go to your heirs. If you're married, it would go to your spouse. If you're not, it'll probably go to your kids. And if you don't have kids, you designate somebody. By law, you have to designate somebody as your beneficiary on a 401k. So no, it's not going to go into the wind. It's not going to go to Scott Brown, unfortunately. I've tried that a few times. People go, you need a beneficiary? No, never mind. So it's not just going to blow to the wind. It's not going to the government. It will go to your beneficiaries.
Now, does it go to them as a 401k, or do they just can get that money and they're taxed on it?
That's an excellent question, actually. So no, it can be rolled over into a beneficiary IRA where they won't be taxed. Now, there are some requirements to withdraw the money over time, but yes, it can be rolled over into a spousal IRA or to a beneficiary IRA.
Okay. And mine is always like, I look at the number, I sit there, and you say, don't touch it. I know you say don't touch it. Mm-hmm. But isn't there a version of like, I remember this in the paperwork sort of, that like I can give myself like if there's an emergency, I can like borrow that money real fast.
Some plans do have a borrowing provision. As we used to say in the 401k business, the three biggest problems with 401ks are loans, loans, and loans. And the reason we say that is because people will really shoot themselves in the foot. Now, first of all, you have to qualify for a loan, and each plan has different qualifications, and it might be a first-time home purchase. It could be a medical emergency. But short of that, it's really hard to get the money out, and you do have to pay yourself back, which is not the end of the world, but it does kind of, if you have $50,000 and you take 30 of it out to do something with, obviously you're kind of shooting yourself in the foot long term.
Now, when you're paying yourself back, are you paying taxes on paying yourself back, or is it just like you're just reinvesting it back in?
No, it's pre-tax. You would pay it back. So you're not getting smoked on taxes when you do that.
Interesting.
Yeah, and there are limits. I think the current limit is around $50,000. Don't quote me on that, but it's somewhere in that neighborhood.
Okay. Well, then this sounds like the way to go.
Well, I mean, again, it's not.
Why is it called 401k though?
Oh, that's the tax code that implements. So here's the hilarity of our politicians, if you will. And I'm going to tread lightly here, but the hilarity to me is that this plan was created. I don't even remember. I'm sure Tammy can look it up real quick and see when 401ks were created. But when they were created many, many years ago, they were created by Congress. Congress said our Americans are not saving enough. Back in that time, we were saving nothing. We were saving 1 or 2% of our income. That's not going to cut it, and Social Security is not going to pay for everybody. They knew this. So they had to provide incentives for people to save to replace pensions and things like that. So they created the 401k. Now cut to 30, 40, 50 years later, all they can do is criticize 401ks. Looks like, 1978? So they were created in 78 by politicians, and now every politician you listen to hates 401ks. And they hate them because they want something to beat on. They want something to say, well, here's how we're going to save you from these awful 401ks with too many fees and too many bad mutual funds or whatever. I mean, they just make up things to hate, basically, at this point. But the reality, again, is it was created by Congress. It was created because they saw that pensions were disappearing. And it was created to create a tax haven, and it was created so that we wouldn't retire in poverty. The problem is a lot of people haven't taken advantage of that opportunity. Now, sometimes, to be fair, employers don't offer them. All employers don't offer them because most employers are small employers. But I would say on average, 70 to 80% of the American population has access to a vehicle like this.
What do you think stops people the most from jumping into something like this? Like it just seems like the smart idea. Is it just we're not good with waiting?
Yeah, it's just discipline. People, and let's be honest, life's hard. Life's expensive. We've talked about inflation. I get it. It's to say, well, that $50, that's a tank of gas. Or at least it used to be a tank of gas. It's half a tank of gas right now.
Yeah, right now it's half a tank.
Yeah. So I get it. And I have kids. I need to feed those kids. I got a house payment. Whatever it is, Americans tend to build their lifestyles right up to the edge of their budget. And the problem is they didn't think about that. And it's always going to be tomorrow, right? What I hear a lot is I'm going to do it when I can save $500 a month. Right now, $50 a month doesn't mean anything. That's wrong. $50 a month means a lot when you're in your 20s. It could even mean a lot when you're in your 30s because you have 30 years of compounding ahead of you. So it's just human nature. It's to put off the satisfaction or whatever it is we're putting off, gratification, I suppose, is hard for most people. We're not, evolutionary speaking, we're not designed for it because there was no saving wasn't a thing when we, 1,000 years ago.
Yeah, the meat goes bad.
The meat will go bad. Eat it. The water, drink it. Whatever's happening, do it right now. And our brains just haven't quite caught up with the modern infrastructure.
I've seen so many studies on that, and I think you hit the nail on the head, absolutely. And especially the thought, I remember reading that like when people make more money, they just end up spending more money. It's not like they build this like great wealth in the background. So don't do that, America. Don't do that. Try and live within your means. Have a little fun, but don't go too crazy. That was from old Ryan Holmes. And his views and opinions are not those of Scott Brown's. He might have better advice for you.
There is not better advice than that. That's fantastic advice.
We'll be right back with more It's Only Money. And welcome back to It's Only Money with financial advisor Scott Brown with EdgewaterFamilyWealth.com. That number again, 407-648-1881. Or you can also email us at EdgewaterFamilyWealth@RaymondJames.com and send your questions in to Scott, and we will try and answer them on air as well. Just keeping with our conversation about 401ks. When I signed up for mine, I found it very interesting. Like I don't know anything about money, but they gave me like it was a website, and then there was a scale on it, and it just said, "How risky do you want to be?" And you could move the slider over to like super safe or super risky. I slid that thing all the way into risky, and I called it a day, and that's the most I've done on it. Now, I get all kinds of paperwork every so often with it, like it had with like all kinds of details and things like that. I really don't know what a lot of that stuff is, to be perfectly honest with you. And I don't even know, like, really how they're picking the stocks because I have it set to where they do it.
Yeah.
Is there a version where you pick your own?
Sure. There's all kinds of bells and whistles in 401ks to try to make them appealing and marketable to the average investor. But yeah, sliding your slider all the way over at your age is not a bad thing. I mean, as we've talked about in previous episodes, the more aggressive you are, the more likely you are to earn a higher return long term, but also the more likely you are to get punched in the face every once in a while. But at your age, it really doesn't matter, right? So unless you are planning on retiring tomorrow, which I don't think you are.
No, not anytime soon.
Okay. Being aggressive, which is probably the proper term, is not the end of the world for a young person. Just be aware of what you're doing. Speaking to which, there are components of 401ks that people should understand, but it shouldn't keep them from participating. When I say, people get caught up in this stuff, I'm not saying be ignorant. There are things like expense ratios, which, by the way, have come down like 80% over the last decade because people became aware. So awareness is a good thing. They didn't want to be overcharged. They wanted to be competitive. So, Tammy, how would you describe the cost inside of a 401k or the investments in the mutual funds themselves?
Yeah, you can think about it as a management fee, right? Paid to the fund company for the benefit of owning the fund itself. And that usually comes out when you think about it, when you invest in it, you have to keep it in mind because that number will come out of the return of that investment vehicle.
So let's say I earn 10% 1 year in a mutual fund and it has a 1% fee.
Exactly. So you'll end up net 9.
Okay.
Because you're 10, you take out a 1, and you end up at 9. Now, there's also things like a yield, right, on the fund itself.
Okay.
Which is think about it like dividends. It comes in annually, you get that, and you add it to your return as well. And that's what we call total return.
Sure. So total return is made up of two components, right? It's the growth, which would be I bought a share at $1 and it went to $2, right? That's one component.
That's
the other component is the dividend. Some people think of it like interest, which also gets added to the total return.
Exactly. And then you take out the expense ratio and you end up with net.
Yeah, no, some people don't like expense ratios, which I get. Nobody wants to overpay for anything. But as I've said to participants, they say, I don't want to pay these fees. I sounded like Ryan just now. I'm taking on his voice for some reason.
It's a good impression. I thought I was talking for a second.
Yeah. So they don't want to pay the fees. And I said, well, that's great. Nobody wants to pay for anything. But if they don't get paid, they're not going to do this, right? So at some point, somebody is going to get paid. It's just you just want to make sure you understand what you're paying for.
Of course. And it is also important to know that there are, if you look up around the fund world, as we call it, you may find two funds with exactly the same components, but one of them has higher charges.
Yeah, and that's where, most plans have an advisor attached to them. So having a conversation with that person might seem awkward at first, but they can typically explain these things to you. So in your plan here, Ryan, there's somebody walking around in a suit from time to time that helps you guys figure out the dynamics inside of your plan. And Tammy, talk about the different opportunities, whether it's through an ETF or a mutual fund. Typically, they have a lot of choices in a 401k, right?
Of course, yeah. And then you have different strategies. There is something called a target date fund where let's say the management company will take discretion in moving the assets within the fund itself as you progress in time and age.
Do they tend to get more conservative, right?
Of course.
Over time, as you age?
Because people age, yeah. I wish it was the other way around, but...
Yeah. So to your point, Ryan, probably what you bought is a model portfolio that's either called growth or aggressive or balanced. The other option is target date funds, which have dates, right? So if you were going to retire in 2035, you would buy a fund that says 2035. It's designed to make you more conservative as you age into your retirement date. I have a little bit of an issue with that theory, but it's certainly not terrible.
What would your issue be?
Well, I because you don't know. I think making somebody more conservative because they've gotten older doesn't always make sense. What if they still need to earn a higher return, right? So the example I always give is if you walk in with $1 million and you say to me at age 25, I only need to earn 2% to be successful. Okay, well, you just told me you only need to earn 2%. We've done the math. If you save and you conversely, and you're a young person, right? So I can make you conservative. I can afford, in fact, I have to make you conservative because that's what you told me you needed. Conversely, if a 65-year-old walks into my office with $1 million and they need $80,000 a year, I cannot be conservative with them. Despite the fact that they're 65, they need to earn 8%, right? Which may or may not be realistic, but the reality is being conservative for that guy is not an option. His age has nothing to do with it. So I think people have been taught these simplistic ways to look at things. Take my age and divide it by 7 and carry the 3.
Yeah, it's like dog years.
Pies involved somehow.
There's a math formula to figure it out is what I was going to ask.
There's not. It's dependent on the individual. Some of my clients in their 70s are trying to earn 2%. Some of them are trying to earn 5.5%.
I want to meet those people.
They
sound fun.
But it's based on what they are fun. But it's based on what they need. Not some simple rule that we can all follow, like zombies, so to speak. I mean, you have to look at the individual and what they need.
It's not one size fits all.
Yeah, for sure.
And that's the benefit of having a financial advisor, generally, because you can't just scroll through the. Trust me, I've looked. You can't just scroll through the internet and figure out like, okay, well, this math formula works. I'm just gonna go that way, and this will definitely work out for me.
Yeah, there's no algorithm which is, X plus Y equals success. That doesn't exist. It doesn't exist in the investment world. It doesn't invest in picking stocks. If it were, everybody would do it. So again, there's a lot of twists and turns. There's a lot of randomness to some of this stuff. Nobody predicted that Russia would invade Ukraine a year ago, right? Nobody was doing the math on that, right? You could say, well, I did the math and I looked at this stock and I read their balance sheet and I read everything I could read, and then Putin invaded Ukraine and it went down anyway. Right, so there's a lot of randomness, easy for me to say, in the markets themselves, in 401ks, whatever it is. The people that learn to deal with that understand it's not perfect, and there is a lot of things that are going to happen out of their control, are always the ones who do the best.
And when you talk about like you get punched in the face with a riskier portfolio, when an older person, maybe they started planning for retirement later and they do the risky way and they get punched in the face, so to speak, financially. What generally happens? They just, instead of getting their 2% that they're trying to live off of, it goes down to like 1%. Are they getting nothing?
No. So in fact, there's an element of that today. So the conversation I'm having with clients right now is not, hooray, look how well we did. It's, hey, we're going through a tough couple of months. We have already done the planning for the last 10, 15, 20, some cases 30 years that provides for this moment. As I've said before, you can't do the planning while it's happening. You have to prepare in advance. So for a client, like we'll make up a hypothetical client who's 68, they've got $500,000 saved and they're spending $20,000 a year. Every year, every 6 months when I talk to that client, I make sure they have enough cash or short-term available liquid investments that they can use during a time like this for a year or two. I'm always prepared to go through a year or two because the average bear market lasts how long, Tammy?
14.5 months.
And he knows that because we just checked, right? So we just did a study on that. So the average bear market, when I'm talking to a client, every 6 months I'm saying, listen, the average bear market lasts 14.5 months from peak to bottom to back to peak again. I need you to be prepared liquidity-wise to weather that storm, because what I don't want them to do is say, well, by golly, I said I need that money and I want it and I don't care what the share prices are. Well, the share prices used to be $10, now they're $5. So for me to get you your income, I have to sell twice as many shares, which means two things. One, I had to sell a bunch more shares. And two, when the market comes back up, you have half as many to come back up with. So the reality is the preparation should have already been done. And the conversation I literally had this morning with a client was, hey, Scott, the client said, hey, it's, bad things, yada, yada, yada. What are we going to do? And I said, we already did it, man. I'm like, we have the cash on hand to get you through the next 12 to 24 months. We don't have to sell anything or do anything.
That is the most calming answer you could ever give somebody, by the way. What do we do? We already did it. What?
Mm-hmm.
Okay. Great call. Have a great day. Talk to you in 6 months. That is awesome. That's why you want to have a conversation with Scott with EdgewaterFamilyWealth.com, because we've talked about this on other episodes, but there's no too late to start planning for this. Like if you think you need to do it, then now is the time. So talk to Scott, 407-648-1881, and we will be right back. Welcome back to It's Only Money with financial advisor Scott Brown with EdgewaterFamilyWealth.com is the website, or you can go to 407-648-1881. Tammy is here as well to lead us down these financial roads, and I'm having a good time. And you can also email us. You can email EdgewaterFamilyWealth@RaymondJames.com with your questions for Scott. And Scott, I've got some doozies for you this week.
Lay them on me.
Okay. Question number one is the most obvious question that I have not asked yet, but it comes from DJ in Ocoee. He says, what is the initial meeting with a financial advisor like? Is it like a doctor's visit?
Well, there's no peeing in a cup or your blood drawn, but it could
Be weird if it was.
Yeah, well, you never know. So yeah, it shouldn't be intimidating. I think one of the things that happens more often than it should is that the potential client walks in to meet the advisor and the sales process begins, right? They're like, all right, this is what you need. Well, how would you know what they need if you haven't listened to them and at least taken down some basic information on what they're trying to accomplish? And unfortunately, I think less and less, if I'm being optimistic, but still there's a lot of sales pressure to buy a product, or you need an annuity, or you need this, or you need that. The reality is it should be a whole lot of listening done by the advisor, right? You should be doing most of the talking. They should be prodding you to ask thoughtful questions. What has your experience been? Why are you here? What concerns you about money? When you were a child, how did your parents behave with money? How did that influence you? What are your concerns going forward? What are the tax concerns you have? What are you trying to accomplish, right? What things have you done in the past that you liked, and what things have you done in the past that you didn't like? This can go on for hours. And I would argue you should never, never, never make a decision in the initial meeting. Now, I've had people walk in and try to hand me their money the second they walk through the door, but I always tell them, I want you to go home and think about this. This is a big decision you're teaming up with me for on your life savings. Think about that. The person that you want to hand your financial future to. It's not... People get all caught up in the minutia. What's the expense, and what's the return, and what's the market gonna do, and what's going on in Easter? And no, let's slow down for a second. Let's back up. What are we trying to accomplish long term? That advisor should take a moment to explain their process, how they interact with you, how they're going to do things administratively. One of the things about a financial advisory practice, a good one, is the administrative side, which is a pain in the butt. Documentations, trusts, wills, estates, insurance, real estate there's so many legal documents. There's so much minutia, so many regulations, so many guidelines, that part of what you get from a good firm is to take a lot of that off of you. I know my assistant, Linda, who's been with me for 26 years, half my clients don't talk to me throughout the year, except for their reviews. They talk to her like once a month because they need a form sent here. They're trying to buy a house for their kids, so they need some documentation on that. How much insurance do I have? I'm starting to build my trust. I need the documentation on that. How do we fund the trust? I mean, there's so many things that go into building wealth. The good news is you're building wealth. The bad news is there's a lot of paperwork in building wealth. So getting back to your initial question, which I've kind of gotten away from, is it should be a conversation. And I said this, I think it was last week or the week before. I said the best part of working with an advisor, when you're working with he or she, is the conversation. It's not, are they going to pick the best stock or the best fund or give you the secret formula to success? Because if your financial advisor is still coming to work every day, that tells me they probably don't have the secret just yet, right? So what they're about is process and conversation. And the best conversations I've had, the best consultations I suppose I've had with clients is over a cup of coffee at Starbucks for 2 hours, them telling me, yeah, this is going on with my kids. So my adult kid, one of them's this, one of them's that. My mom's not doing so well. Her new husband's doing this. I'm concerned about that. This is going on at work. This is going on in my business. This is going on with my spouse. You know, these are the conversations where you start to get a feel for somebody and get to know them. And until you actually know somebody and you know what drives them and you know what their preferences are, what their priorities are, and a lot of times they don't know till they have the conversation. It's really hard to help somebody build a process when they don't know where they're going, and those conversations help determine that.
Scott, this sounds like therapy.
Oh, buddy, I literally had a couch in my office for years, and you would not believe some of the things people will tell you when they sit on a couch.
I mean, like everything you're describing is just like that sounds like a conversation I have with like a therapist. Let me ask you this: so, when people talk to you, I mean, with a therapist, you don't open up to them right away, right? Now, do people take a while to open up financially, so to speak, and then B, does it take them a while to reveal something horribly financial that you don't know right off the bat, and then that's like visit 5, and you're like, wait, what?
There's not a lot of that.
I guess you see the numbers.
Yeah, I can kind of usually see the numbers pretty within the first or second meeting, but you know, the truth of the matter is that it does take a while to build trust. You know, there's some people you click with immediately, whether it's a doctor or a lawyer. You're like, oh, I'm into this person, they're into me, there's a good connection. And that happens for me sometimes too, but I think even then it takes 6 months to a year to really develop a rapport with somebody and understand, oh, this is how they react to this, and this is how they react. Like, I know almost every client I call, I know exactly how they're going to react to a situation because they've been with me so long. So I can kind of get a feel for their personality. I kind of know how to steer that type of personality. You know, if they're very reactive, I already know what I have to bring to the table to make them comfortable again. If they're very laissez-faire, Scott, I don't care, just send me my statement every year, and why are you bothering me kind of, I have to kind of grab them by the ankles and say, no, turn around, I need you to look at this for a minute. And I have a lot of those, by the way. So it does take a little while to build a rapport and an understanding between us and how we're going to conduct business.
Do you get to the point with your clients where just like you just straight up yell at them like you're going to listen to me, or is it just, it's always just on the level and it's a lot of just reading them out?
I have had some very awkward conversations over the years. I've been told I'm a little straightforward. I know you can't imagine that.
Yeah.
But I don't know any other way to be. I feel like sugarcoating or dancing around or using jargon to confuse them so they won't ask a question. I mean, look, I'd rather tell you now that there's a problem, whether it's on my end or your end, and what that problem is, because if I let it fester, if I let it go too long, it's going to become a bigger. Problems don't go away. You have to address them.
Yeah, it just seems like it's you're a financial therapist, and then when people come to you, like when you're talking about this, you're like, oh, they're worried about the fees, or like you're giving them a pitch, but the whole thing is, you're there to make them money. Like they're not they're gonna walk away with more money no matter what. Doesn't that make them feel better?
Well, it's a confusing thing. So, you know, there's a lot of media hype around the fact that advisors might not have your best interests at heart, which arguably could be true in some cases. But I think less and less that's true. I think most professionals view themselves as such, and it doesn't behoove any advisor who gets paid based on the growth of assets to not grow the assets, right? You know, we're typically more often than not anymore not commission-based. I haven't had a commission in many, many years. It's fee-based. It's you make money, I make money. You lose money, guess what? I lose money, right? So you need to make sure they're on the same side of the table as you. But make no mistake about it, we're getting paid. I mean, it's how we make a living. You know, I could do it for free, but that would really upset my wife and kids. They like things. They like to eat. They like college paid for. So no, I think it's a noble profession that sometimes gets a bad rap because of a few bad actors, but that's true of any profession. So it behooves the advisor to help you grow your assets. And do they always grow? Well, long term, yes. Short term, sometimes it doesn't grow so fast. Sometimes it doesn't work. Sometimes you get a client. You know, if I got a client in 2007, let's say late 2007. I promise you, by the end of 2008, they thought I was an idiot because the market was down 38%, right? And I wasn't an idiot, arguably, but no more than I was a genius over the last decade when we've been in a raging bull market. It's really just understanding the environment you're in, building a process that works for you, and saying, these are the disciplines I'm going to deploy or employ to get where I'm going. And if the market goes down, I expect that to happen on average every 3 years or so. Now, we've been better than that lately, but that doesn't mean the averages won't come back to us. So, again, it's are you having meaningful conversations? Are you building a disciplined and repeatable process, and are you sticking to it? And that's what an advisor, in addition to all the administrative stuff, can really help you with.
Well, I've definitely talked to people that have been with you for a long time, and they're very happy with your work. Although I don't think you should title your next book, Am I an Idiot? Maybe. Am I a Genius? Sometimes.
Actually, that was the actual working title of my new book.
Well, we got to work on this marketing thing. You can find Scott's actual book, I've Never Made Anybody Rich, on Amazon, and it is a good read. And if you got Kindle, you can just get it right now.
Right. And let's talk about that title. I very purposefully, is that the actual? Yeah. That's the actual word. I did that on purpose. Let's just do it that way. I did that on purpose because I think people go into advisory relationships thinking the advisor is going to make them rich. That's not their job. Their job is to maintain wealth and move it forward in a responsible way.
Well, if you want to move forward in a responsible way with a lovely human being, contact Scott Brown at edgewaterfamilywealth.com. You can email him. Again, that's edgewaterfamilywealth at raymondjames.com. That number, 407-648-1881. Scott, Tammy, always good to see you, gentlemen.
Likewise.
Likewise, man. Good to see you, too.
Have a wonderful week. Bye-bye. This has been It's Only Money with financial advisor Scott Brown.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, they're people. They're regular people.
Now that guy I trust. See, the problem, Scott, you don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.